Stock selling off here. We've got investors worried about the risk of recession yet again, thanks to that inverted yield curve. And joining us now to discuss is Kathryn Rooney Vera. She's head of research and strategy at Bulltick. So, Kathryn, are you worried about a recession as much as we keep seeing it in articles and seeing it on Twitter? Is it something that your clients and you are concerned about?
This reminds me very much of December of last year when we had the combination of three potent variables, which was fear of U.S. recession, fear of trade war, and fear on the Fed take down the markets 20%, nearly 20%, let's call it that. This time around, however, we're not seeing that in the equity market, but we are seeing that fear manifested in the Treasury markets. I think that we're going to get growth above 2.5% this year. I think 2020, I don't have the probability very high of recession, so I'm taking the other side of the bet. I do think that trade war and these escalating tensions are going to culminate into an eventual deal. And I do contend, of course, it's a high stakes game, but a lot of the back and forth and the high stakes talk is part of the negotiation.
Kathryn, I just would ask then, I guess, what you think about the Fed right here, because I think part of what the bond market is looking at is maybe they're concerned about the global economy, maybe they're looking at a recession, but also I think a lot of people believe the Fed will cut rates at some point over, let's call it the next 12 months. I mean, considering they're still not done winding down their balance sheet, they're still in the middle of a tightening cycle. Do you feel like a Fed cut is actually in play, or is this just something that appears to be priced in but isn't what traders really believe is going to happen?
It could very well be in play if we get the recent trend that we've seen in core PCE continue, but I don't think that's going to be the case. And the trend that I'm referring to is since December, we've had every month core PCE year over year showing a deceleration rather than an acceleration. So the Fed has definitely reached its dual mandate, but of course it has a third mandate, which is the financial markets. We're at full employment, de facto full employment. We have very low inflation. At this point, I don't think it's required. I bet they stay on hold. There's no real pending and imminent reason to cut rates. Economic growth remains pretty darn good. And if you look at consumer confidence, which I tend to look at, it's really hard to call for a recession right now in a consumption-based economy because of fears on trade war, which we haven't even seen manifest yet in the numbers. Let's remember that the U.S. is not an export-based economy. The impact of the tariffs on Chinese imports is going to directly impact immediately inflation, and the indirect pass-through effect is ultimately to GDP. But if you expect this to be short-term rather than a multi-year scenario, then that impact is temporary.
Kathryn, Dan Roberts here. I'm with you. It's sort of hard to reconcile the fears and those who are calling for a potential recession with the consumer confidence being high. Now, at the same time, even though the conversation is so focused on China and global growth concerns, U.S. companies, we do see some troubling signs that really seem separate from China. I mean, when we look at earnings reports, we've seen profit growth decelerate a little bit. So separate from the China concerns and the ongoing trade war, what do you think are the obstacles for U.S.-based companies for growth in the next few years that maybe people aren't focusing on and should be?
Well, this is a really long expansionary cycle. It's a mature cycle. So certainly I would expect to see some deceleration in economic activity. Remember, we had 3.2% seasonally adjusted annualized rate of growth for 1Q. So we're likely to, Dan, see a deceleration over coming quarters, but that's a far cry from calling for a recession, which is what the likes of Morgan Stanley are now saying is imminent. It just reminds me so much of last year in December. And at that point, we said, guys, go long the markets right now, go long emerging markets, go long S&P, and go long those sectors that are most impacted by fear with regard to trade war. I mean, remember last year, Dan, you even had the IMF reducing global growth forecasts on the concern of trade war. It hadn't even yet manifested. So I would say let's take a breath here, do the homework, analyze it, and see what the real impact is. And there has to be a scenario analysis here. So if this is a short in duration war, if it doesn't escalate any further, that's one thing. If we're calling for a full-blown trade war, which by my definition, this is just my own personal opinion, this is what I'm telling my guys, is that, look, if this becomes something that covers the totality of U.S. imports from China and extends several months, I get worried. I get worried because the inflationary impact on that is far greater than what it is right now, which is really insignificant.
Kathryn Rooney, Vera, Head of Research and Strategy at Bulltick, thank you so much.
My pleasure.